Before starting today's session, let me just ask one or two questions from you. Last week we talked about specialized leasing companies. Can specialized leasing companies accept deposits from general public? Say yes or no. In the chat box, send me your answer. Can specialized leasing companies accept deposits from general public? Say yes or no. Last week we discussed this. Can specialized leasing companies accept deposits? Say yes or no. Very good. If they cannot accept deposits, what are their funding sources? Tell me a few funding sources. What are the funding sources of specialized leasing companies?
Promissory notes, commercial papers,
and
bank borrowings.
Okay. Debentures, then IPOs. It's right. Thank you. We'll start today's session. Last week we talked about insurance and we talked different aspects of insurance. Now we are coming into reinsurance. The insurer getting insured. If you are the insurance company, what are you doing? You are undertaking others' risks, but you yourself is undertaking a risk that you can transfer to someone else. So that is reinsuring. Reinsurance is the practice whereby insurers, so the insurance companies, transfer portions of their risk portfolios to other parties. Okay, so the insurance company is undertaking risk. That risk is transferred to other parties by some form of agreement to reduce the likelihood of paying a large obligation resulting from an insurance claim. Now, insurance companies have to meet the claims from their insurers. Insurer is the insurance company. Insuree is the customer. Sometimes a large number of customers would make claims. That can happen when a catastrophic incident takes place. For an example, tsunami. When tsunami hit Sri Lanka, lot of properties got damaged. Owners of these properties would go to insurance companies and claim damage at once. If that happens, the insurance company may become bankrupt. On such, the insurance companies themselves have transferred portion of their risk portfolios to other parties. So they get reinsurance claim and honor the claim of the customer. The party that diversify its insurance portfolio is known as the ceding party. What is reinsurance? In simple terms, reinsurance is the insurance for insurance companies. Insurance companies undertake risk. That portion of that risk is transferred to third parties. It is a means by which an insurance company can protect itself from risks. As I mentioned, one individual case randomly happened, the insurance company undertakes that. But what if a catastrophic incident takes place? Tsunami, cyclones, fire running out in a large city, earthquakes, terrorists, bomb attacks. When lot of properties got damaged, one single insurance company will not be able to honor all the claims. So what they do, they also transfer risk to other parties. The company who requests for the cover is called the cedent, and the reinsurer is called ceded. So there are two parties, cedent and ceded. This picture will show you what is reinsurance. A mental picture. The umbrella is protected by another umbrella. That is protected by another umbrella. Umbrella is being protected by umbrella. So that is very simple concept of reinsurance. Okay. Another term coming under insurance is bank assurance. Banks are managed by, regulated by, supervised by one set of regulators. Insurance companies are regulated by another regulator. But these two different institutions will find there is an opportunity if we do business together. So the collaboration between a bank and an insurance company is called bank assurance. To sell the products like life assurance and other insurance products to a bank's client, insurance company will find having a desk in the bank would enable them to sell more. A leasing company will lease out vehicles and each vehicle will have an insurance policy. So having a collaboration between the bank and the insurance company is known as bank assurance. So bank assurance is connecting two different products where the benefit goes to both parties. Now, if you ask what is bank assurance? So bank assurance is a relationship between a bank and an insurance company that is aimed at offering insurance products or insurance benefits to the bank's customers. In this collaboration, in this partnership, bank staff and tellers become the point of sale and point of contact to the customer. So both parties get the benefit. It's a win-win situation. Okay. So under insurance, we talked about types of insurance available. What are the two types of insurance products available? Can someone tell me the answer? Two types of insurance products. What are they? Yeah. Yeah. Life and general. Very good. Life and non-life. Okay. Very good. Then if I ask, tell me 5 general insurance products. Name 5 general insurance products. Fire. 4 more. Motor. Marine. Yeah, this. Okay. Burglary and theft. Public liability, product liability, cash in transit. Good. So you can answer this type of questions. Very good. Now, we talked about bank assurance. So bank and an insurance company having a collaboration is known as bank assurance. Okay. Right. Now, there is a very important concept called moral hazard. When you find you are protected, when you find that you are always protected, you prefer to undertake more higher risk. We have seen sons of rich billionaires tend to behave in a very carefree manner. They know one thing, whatever happened, they are protected. Therefore, they want to undertake more and more risk. The same happens with insurance. When you believe that you are protected by insurance, you are no more worried about accidents. You are no more worried about theft. You believe you are protected. Moral hazard. If your insurance is insurance against theft, there is no reason to lock the car. I'm not afraid. If you are paid a fixed wage and there is no risk of being laid off, there is no reason to work hard. If you get sufficiently high unemployment compensation for an indefinite future, there is no reason to look for a job. Moral hazards. Okay? When you know you are protected, the way you behave is very harmful. Now, what is moral hazard? Moral hazard refers to the phenomenon of a person's behavior being affected by his or her insurance coverage. Moral hazard is known to exist in all types of insurance markets. People became careless. One very good example is the recent damage to our environment caused by a ship. Okay. When these damages were taking place, some of our responsible people responded and said, no need to worry, we will get a very good insurance claim. Means what? When you understand there is an insurance claim, you prefer the property to be damaged. That's moral hazard. Moral hazard arises when someone who is protected from loss fails to take measures to avoid excessive risk. The term originated in the insurance business, where people who are insured against loss fail to take measures to minimize the risk. Okay, so those who have flood insurance may build proper buildings in areas where it's prone to flood. Now you can understand what is moral hazard. When you are covered by insurance, you behave recklessly in a very harmful manner because you believe you are protected by insurance. Tell me one mechanism where insurance companies try to get out of this moral hazard. Okay, in short, the insurance companies want the insuree to protect its properties as if they are not insured. In this thinking, insurance companies offer certain activities, certain products, certain benefits to the insuree to look after their assets. Tell me one nice example of mechanism where insurer motivate insuree to protect its properties. What is NCB? Very good, I got the answer. No claim bonus. Okay, so I got the answer, very good. No claim bonus. With no claim bonus, the insurance company try to make the customer understand it's better not to make claims by unnecessarily putting the vehicle or the property in a risky situation. Then another important area under insurance, SLDIC, Sri Lanka Deposit Insurance Scheme. Deposit insurance is a measure implemented in many countries to protect bank depositors. That's another moral hazard. Okay. So in Sri Lanka, in January 2018, it was announced when a bank or a finance company collapses, the depositors will be paid back maximum 600,000, or its equivalent in the case of foreign currency deposits. Okay, so whatever you have deposited in a bank, irrespective of the amount, you will get maximum ceiling of 600,000. Okay? So CBSL implemented a mandatory deposit insurance scheme under the provisions of Monetary Law Act with effect from October 2010. All commercial banks and finance companies are members. All deposits except the following are eligible for the scheme. So everyone who has deposited will be given maximum 600,000. Say you have deposited 50,000, how much you would get? That's 50,000. If you have deposited 550,000, you will get 550,000. But if you have deposited 1 million, maximum ceiling applies 600,000. So that's how you are refunded. And all deposits are eligible except these. So what are they? Deposits excluded from Sri Lanka Deposit Insurance Scheme. Any deposit by government of Sri Lanka. Shareholders, if they have deposited money in the particular bank that got bankrupt, they will not get their deposited money. Justification is such: being a shareholder, you are part of the owners. Owners are responsible for what has happened. Directors, you are the director and you deposited money in that bank which comes under your purview and you have failed. You are not given your money back. Key management personnel, you have been a powerful member of this bank, an employee, a very powerful employee. You have not done duty. As a result, the bank has got bankrupt. Your money will not be refunded. Other related parties. Deposits falling within the meaning of abundant properties. Now, what is abundant property? Okay, so we are moving from one word to another, from one subject area to another. Abundant properties. The Banking Act number 30 of 1988, section 63, 72, 76 deals with abundant property of customers in banks. Under those provisions, details of all such money and property in the name of owner, etc., which have not been operated on for 10 years must be notified by the bank concerned to the CBSL. Then what happened? Within 30 days of such notifying, the central bank, the bank submitting the particulars must also publish in the daily newspapers in all 3 languages relevant particulars of the abundant property, including the names and addresses of the owners, and also send a registered letter to the last known address of the owner. A bank may exempt it from taking these steps by central bank. Thereafter, the owner of such property or any person who can establish a claim to such abundant property can claim such property by providing adequate proof to the central bank. The method of claiming such property is set out in Section 75 of the Banking Act, while Section 76 enacts that any bank that fails to comply with these provisions relating to abundant property shall be guilty of an offence under the Act. As per Sri Lanka Deposit Insurance Scheme, in the event of collapse of a member institution, in suspense of cancellation of membership, depositors will be compensated up to a maximum of 600,000 Sri Lankan rupees per depositor. Okay. Now let's talk. We are talking about deposit insurance scheme, which covers all the depositors. My question is, just say yes or no. Is this a good move? The depositors who have deposited in a failed institution will be paid back at least up to 600,000. Is this good? Say yes or no. Okay. $0.6 million, 600,000. The recently that was given for, yeah, CIFL. Okay, right. Now, those who say yes, there is a reason for them to say yes. For those who say no, still they have a reason, right? I first like to listen from those who say yes. Now, those who believe there must be Sri Lankan deposit insurance scheme and on at least up to 600,000. Why do you say yes? Why do you say there must be a deposit insurance scheme? Yeah. Just tell me one or two sentences justifying your yes. Why do you say yes? There is a reason. Yes, I accept the reason. Just spell out. Just tell me why. Yeah, when deposits are insured, general public will believe they are protected and they will have faith in the banking system. They will have trust in the banking system. That will ensure financial system stability. So that is for the good side. Now for the bad side, those who say no, they also have a valid reason. What is that? Can someone just tell me why do you say no? They also have a very valid reason to say no. What is that? When you are protected by deposit insurance scheme, you believe you need not to study about the institute that are going to deposit. Let's say Fitch rating. It's unfair to those customers who deposit more than 1 million. Okay, now let's look into the real big picture. We talked about Modal Hazard few minutes ago. What is that? When you are protected, you behave in a reckless manner. Okay. When you understand there is finance institute A, there is finance institute B. A, for the fixed deposits, they will offer you 6%. And their rating is AAA. There is institute B, which offers you 12%. Yeah, that's it. 12%. And the credit rating is C minus. But still, you go and deposit in institution B. Why? Because you are greedy. You believe, you know that higher the risk, higher the reward. You know that. When you know one offers 6%, the other is offering double, 12%. I prefer the double amount. And I will laugh at those who went and deposited in well-managed finance institute. Now, my finance institution is not well-managed, that is ill-managed. But still, I'm happy. Why? Because I get 12% return, very much more than the other party gets. And all of a sudden, this institute collapses. But still, I get my money. Moral hazard. What is happening? Depositors are like promoted to go and deposit in ill-managed companies. That's not healthy for the well-managed company. So this is where your argument comes. It's unfair to those customers who deposit more than 1 million. Okay. In order to ensure financial stability, it's better to give the retail depositors who maybe lack in financial literacy get some kind of benefit. It's better. But more than that, let's say those who deposit more than 1 million, they have a wealth and they must have a financial literacy. While knowing that, they prefer, okay, 6% more for my 50 million is a huge amount. I'm not ready to sacrifice that. And even if the institute fails, the government will pay me. That's how people say. The government will pay 50 million. So why should I put my 50 million in bank A, where they offer just 6%? And I don't care about their credit rating. I don't care about rating. right? They are AAA. They are well managed, but I'm not worried. Why? Even if it's ill managed, they pay me more. If that continues, more and more depositors will go to ill managed financial institutions, and the well managed will find hard time. So that's the moral hazard. Okay. So this is why there is upper ceiling. We will protect, or we have to protect, retail depositors who lack financial literacy. They don't understand when they go and deposit their hard-earned 50,000, 100,000. They don't look at financial statements. Okay, you will find financial statements of banks and finance companies are published in national newspapers, but these depositors will not read them. They don't understand what is meant by AAA rating. So whatever the rating agencies give the numbers, they don't care. They only look at who appears in the advertisements and come and deposit. Okay. There was a Sinhala website, randora.lk, that's no more, I think. Once there was a very good article. You know, these websites, they publish everything without much ethical writing. They put certain finance companies' advertisements, and cricketers and actors and actresses appeared on these. And they said, okay, people believe in these celebrities than rating agencies. And they say, okay, if a cricketer is appearing on advertisement, it's better not to deposit. I'm not going to say that's the case. But that website ran an article like that. Okay, means what? There are people who lack financial literacy. They only read and understand advertisements, and they believe in the actors and actresses appearing in these sets and go and deposits. Okay, so this is where moral hazard applies. Okay, benefits of Sri Lankan deposit insurance scheme: enhance public confidence in financial sector. Okay, I need not to worry about depositing money in financial institutions. I'm protected. So it enhances the public confidence. Safeguard interest of small depositors with low financial literacy. Just what I said. There are people who are low in financial literacy. They don't have much money. 50,000, 100,000, 200,000, they are hard-earned money. They don't really understand accounts. They don't understand the ratings given by rating agencies. Encourage savings among small-scale depositors. Discourage unauthorized deposit taking. Key. So I have 100,000. There is a well-managed institution, a bank or the finance company which offers me 6%. But my Polimudalali, the informal financial sector, offers me 4 times more than that. When the bank offers 6%, my Polimudalali offers me 24%. And I prefer to go and deposit with him. But when I understand whatever happens, government, as the people say, pay back my deposits, I prefer that than going to the money shop. So discourage unauthorized deposit taking. Reduce the burden on government when mismanaged firms fail. Yeah, people always say it's government responsible, it's government. But here, the deposit insurance scheme itself bail out, not the government. So reduce the burden on government when mismanaged firms fail. Okay. Now comes a nice term, too big to fail. Okay. In US, year 2008 onwards, there was a financial recession, and one by one, big finance institutions started to collapse one by one. On such, the government came up with a bailout package, and they did not allow these banks to collapse. too big to fail. So the cartoonists of those days showed this. The net is created by taxpayers. This is what happened when government, intervened. Okay, look at this cartoon very carefully. Government bailouts. So the picture shows failed financial institutions, Fannie Mae, Freddie Mac, Bear Stearns. Okay, so these institutions collapse, and if they are bailed out, who has to pay that? Government. What is government? It's the taxpayer. Okay. But too big to fail, and that was coined by cartoonists as too big to jail. Means what? When there are very big institutions, when they fail, that affects to the economy. Then small banks or small institutions collapsing. When small institutions collapse, its financial damage, its economic damage is very less. So no one wants to block it. But when very big institutions fail, that affects to the economy. Therefore, they are not allowed to fail. So that term is too big to fail. And some others say, okay, you are too big to jail. In real, you should end up in jail. Now, we were talking about deposit insurance. Okay, yeah. The arguments are agreed. There is something called Modal Hazard. We prefer, with good faith, to protect the depositors. But what happened? We are paving way for the greedy to accumulate more. So this is why there is an upper ceiling. When you say unfair to the customers who deposit more than 1 million, I would say no. If we don't put a ceiling like 600,000, we are promoting unhealthy management, ill management. We are promoting unnecessarily high risk taking. That is not good. That's why there's upper ceiling. But still, why are we going to intervene? Okay, so that's a very good question. Why are we going to intervene when a finance company collapses or the bank collapses? Whatever you call the depositor, small, retail, without financial literacy, still they are also responsible. Right? So that's one argument. Okay. So the argument is, do not intervene. Laissez-faire, let things happen alone. If failed management, if ill management causes failure of institutions, let the depositors also suffer. Depositors have a duty to read and understand the institutions where they are going to put their money. Okay. So there is a very good discussion on that. So that was, okay, so this is something which I found in this book, Ben Bernanke, The Courage to Act. Okay. Can anyone tell me who is Ben Bernanke? Ben S. Bernanke. So in this library of IBSL, you can borrow this book when it's physically open. The Courage to Act, written by Ben Bernanke. Can someone tell me who is Ben Bernanke? Okay, he was the chairman of Federal Reserves. Okay. So he wrote a book, his autobiography, Courage to Act. He was the head of Federal Reserves during 2008 financial crisis. Okay. He says a very good story about this deposit insurance. His example, his metaphor is like this. A person used to smoke, and we preach him, don't smoke. Smoking is bad to your health. He don't listen to us. He continues smoking. And he's a chain smoker. One after one, he lit up a cigarette. And he has a very bad habit. He go to sleep while having a cigarette, okay, in his fingers or in his mouth. One night, okay, you will find smoke, fire coming out of his bedroom. He used to go to sleep with a cigarette in his hand and he's sleeping on a rubber mattress. Now you can understand what has happened. So the question is, will you go and save him? You have advised him again and again not to smoke. He never listened to that. In addition to that, now he goes to bed while having a cigarette. Maybe the cigarette has fallen on the rubber mattress and the room has caught with fire. You are a neighbor and you can see fire and smoke coming out of his room. What will you do? Will you save him? Say yes or no. Very good, not at all. Others? Now that's a metaphor or a mental picture, mental story written by Ben Bernanke in his book, Courage to Act. Others? Do you all agree that we should not go and intervene and save this person? Okay. Ben Bernanke also agree we should not go and save this person. Why? We have again and again advised him not to smoke. It's bad to you, but he never listened to us. So it's time for him to get punishment. But Ben Bernanke says, if that person lives in a wooden house, and if the entire city is made out of wooden houses, we must immediately save this. We must douse out the fire and we must save this person. Saving this person means what? We are saving the entire wooden city. Means what? When a finance company fails, that will have a spreading out effect. Like in a wooden house, a city of wooden houses, one fire will spread out to the rest of the wooden houses. In the same manner, when one finance company fails, that will have negative impact on another. So people want to withdraw their money, we call it bank run. That will fall on another, and that will fall on another. So that was happening in US. Okay. One by one, the banks were collapsing. Who were they? Fannie Mae, Freddie Mac, Bear Stearns. One by one, okay, when one falls, people go and try to withdraw money from the other, and that falls. And then people go to the other. This is where government intervened and put a bailout package. Okay, we will bail out these banks. And with that, this dominoes effect was blocked. So this is why Ben Bernanke take this example. Okay, we need not to go and protect him. We need not to go and save him. But remember, contagion effect. It spread out just by touching, like COVID-19. When a bank collapses, that will affect to the rest of the bank. So it will create financial system instability. That's where you must go and save the ill-behaved person. Okay, so we are coming to the end of this session. What is insurance? Okay, so when you ask what is insurance, you must be able to say that. Insurance is the equitable transfer of a risk of a loss from one entity to another in exchange of payment. It is a form of risk management primarily used to hedge against the risk of a contingent, uncertain loss. If the loss is very certain, no one is going to undertake the risk. Okay, so there are places where earth slip is possible. If you go and build a house in that area, no one is going to insure your house. Okay. Then an insurer or insurance carrier is a company selling the insurance. So insurer is the company. The insured is the policyholder, the person who is buying the insurance. the amount of money to be charged, that is called premium. So monthly what you are paying is a premium. Risk management, the practice of appraising and controlling risk, has evolved as a discrete field of study and practice. The transactions involved in the insured assuming guaranteed and non-relatively small loss in the form of payment to the insurer in exchange for the insurer's promise, compensate. So when damage happens, we are compensate, and that is known as indemnify. So you should know these words. Okay, insurer, insuree, indemnify, that is compensating the damages. In the case of a financial or personal loss, the insured receives a contract called insurance policy, which details the conditions. Okay, so when you have a insurance, you will get a document where everything is put in black and white, the conditions and circumstances. That is known as insurance policy. An insurer or insurance carrier is a company selling the insurance. Okay, right, so that's the. Then comes legal principles of insurance. Okay, now we are looking into some other terms. In insurance, there are some nice terms: indemnity, compensation. So the compensation is only up to the insured interest. Okay, right. We'll first go through these nice terms, and I'll come back. Insurable interest. Okay, so if I want to insure, the property must be owned by me, not someone else's property that I can insure. Utmost good faith. In Latin, they call it uberrima fide. I must disclose all the material facts to the person who is undertaking my insurance. Causa proxima. The insurance must be, the claim must be covered by the insurance policy. Whatever the cause that create the damage must be covered by the policy. First we'll go through, then I'll come with nice example. Mitigation. Right? In case of any loss or casualty, the asset owner must attempt to keep loss to a minimum as if the asset was not insured. Okay, so we are not keeping doors unlocked in banks, and we don't keep money on tables but in safes which are under locked. Okay. Why? Because we are mitigating as if we are not insured. Okay, now I'm going to ask you some questions from these areas. Now let's assume there is a vehicle. In Sri Lanka, you know the vehicle price always fluctuate. Okay. So most of the time, the vehicle price goes up. But all of a sudden, due to certain budget proposals, certain categories of vehicle price may come down. Okay. So the vehicle price is fluctuating, and we insure the vehicle at the market value. Right. Now, let's assume there is a bus. Okay. And I purchased this bus by paying 7 million. Right? Purchased the bus by paying 7 million. And I insured in the first year for this 7 million. Let's assume I paid 120,000 as the premium. Right? Next year, government reduced the taxes on buses. They want to promote public transport and some other reasons, and this luxury bus tax was removed. Anyone who is buying the same bus now have to pay only 3.5 million. Okay? I purchased it at 7 million. The same bus after 1 year, let's assume, can be purchased at 3.5 million brand new. I purchased brand new at 7 million. The same bus, when the tax is removed, by government for certain economic reasons. They want to help to the tourism, luxury buses, and the tax was reduced. It's 3.5 million. But when it comes to insurance, again next year, I didn't value the vehicle, and I paid 110,000 as insurance after reducing no claim bonus. Within 6 months, my bus got met with an accident and condemned. Okay, bus is no more in a usable condition. How much will the insurance company pay me? Maximum. Okay, can someone tell me a value? How much will the insurance company? Okay, now the insurance company is paying me 3.5 million. My argument is, I paid insurance premium of 120,000 for the value of 7 million. Next year, if I'm insured at the value of 3.5 million, my insurance premium must be somewhere around 60,000. But I paid double of that, believing the value of the vehicle is 7 million. So I'm entitled for 7 million. What would you say? What would you say now? I'm insisting. I paid 110,000 after reducing NBC, no claim bonus, and I thought the value is 7 million, and you accepted my payment, and the policy was at 110,000. Okay, so I'm entitled for 7 million. What is your argument? Others, think and tell me. I'm insisting. I need 7 million. What is your argument? Now, if I am paid 7 million, how many buses can I buy now? If I am paid 7 million, I can buy 2 buses. Okay. Am I making a profit out of my insurance? Say yes or no. Yeah, I'm making a profit out of my insurance. Means what? It's better I met with that accident. Now I have doubled the vehicle fleet. And I have made a massive profit out of my insurance. That is not the case. Insurance is to minimize loss. The claim will ensure that I go back to earlier situation before the accident. What is my earlier situation? I had 1 bus. Okay, so when the insurance damage is assessed and when I'm honored, I must go back to my earlier situation. What was that? I was the owner of 1 bus, not 2 buses. I must go back to that position. Okay, so that's one concept. The insurance company indemnifies, compensate, not to make a profit to me, but to a certain losses only up to the insured interest. What was my insured interest? I had 1 bus. I must go back to that earlier situation. Okay, utmost good faith, Uttama fide. Right. A customer got an insurance cover saying he is non-alcoholic. He is not a smoker, but when he died, the death was caused by a fight in a nightclub, where he was extremely drunk and intoxicated with drugs by that time. Should the insurance company honor this claim? Say yes or no. Say yes or no. Okay, why? Why? Yeah, he's out of the policy. He's out of the policy. He has breached the policy, right? Anyway, that's a very nice movie. Trip to Heaven. Trip to Heaven. So these are not compulsory, my dear. If you have free time, just enjoy, right? And I think there's a Tamil movie, Tedding or something. I can't remember the name exactly. In these two cases, in these two movies, they show how insurance companies exploit the customers behind these terms. Anyway, we must understand these terms. Right. Causa proxima, proximate cause. Okay. In year 2004, tsunami hit Sri Lanka. When tsunami hit Sri Lanka, no one knew the word tsunami. Okay. And one of my friends called and said, Muda Godagalno. So that was something we have heard maybe many years ago in Calania. There was kind of incident where she really invaded Calania, and that was shown in the wall paintings of Calania Rajamahavihara. And those days we thought it's not real, it's a myth. Right? So when someone called me and said Muda Godagalno, I never believed that is taking place. Okay? So there is a nice joke. Those days, president was Madam Chandrika Bandaranaike Kumarthunga. This is just a joke, not a real one. Then the Pacific Asia Tsunami Warning Center has sent a message to the president's office. Tsunami will arrive to Sri Lanka by 9:30 a.m. And the secretary sent this message to the president. President is known as always late. She never came to any of the openings or whatever event on given time. She was always late. Then she has asked her secretary, okay, ask Mr. Tsunami to wait for me. I'll be a little bit late. Means what? Tsunami was Mr. Tsunami. We thought it's a Japanese name, a person's name. Anyway, what I want to emphasize is when tsunami hit Sri Lanka, no one knew what is tsunami. Means what? None of our vehicles were covered by tsunami in insurance policy. We had flood coverages, but no one knew what is tsunami. So there was nothing called tsunami coverage. Okay. My question is, should insurance company honor the claims on insurance when the vehicles got affected by tsunami and the insurance policy was not including the term tsunami? Say yes or no. Should the insurance company pay them or no? Okay. Now what happened? Theoretically, you need not to pay. Theoretically, you need not to pay. Why? Causa proxima. You are not covered by the policy. But, okay, now there were some nice arguments those days. Okay. Now someone has parked his vehicle on a river bank, right? And all of a sudden, the river water level went up because sea water is invading into the river. And when the river water level went up like a flood, it has damaged the vehicle. Now the vehicle owner says, my vehicle had flood cover, therefore I should be paid, right? Then there was argument. What is flood? Flood is created by water coming from up, no other way. Okay? So these arguments were going on. But an insurance company came up with this ex gratia payment. When there is no obligation or liability to pay, but I'll pay out of good faith. Ex gratia payment. Okay. So if you had flood cover, we will pay you. Need not, but we will do that. Ex gratia is most often used in legal context. When something has been done, it has been voluntary, out of kindness or grace. Okay. You need not to, but you did it. Then under insurance, we are coming to the end, GWP. In all the other annual reports, the first line, top line is revenue, but for insurance company, GWP. Gross written premiums are the total revenue. So that is the revenue of an insurance company. Come up with a nice term, GWP. Expected to be received by an insurer before deduction for reinsurance or ceding commissions. Okay. So that's before deducting reinsurance. So any other commissions. Surplus gains enable the company to increase gross written premiums and reduce amounts ceded to reinsurers. Then who is the regulator of insurance industry? For banks and finance company, that is CBSL. For insurance, that is IBSL. IBSL in the sense Insurance Board of Sri Lanka. Okay. Then objectives of the insurance company, IBSL, Insurance Board of Sri Lanka. The objective and responsibility of the IBSL is to ensure that insurance business in Sri Lanka is carried out with integrity and in a professional and prudent manner, with a view of safeguarding the interest of the policyholders and potential policyholders. Hence, the IBSL supervises the financial performance, financial strength, and solvency of insurance companies with a view of protecting the public interest and safeguarding the industry as a whole. So, if you are a tiger, you must have teeth. So, the powers and functions of IBSL. Register, okay, advise, implement the government on these policies. Okay, so with that, we'll end the insurance part. Okay, so there are a lot of areas you must know. Reinsurer, bank assurance, IBSL, okay, then different concepts, Uprema fide, causa proxima, some nice terms. Okay, so you should know that. Types of insurance products, all these things you must know. Okay. Right. Now we are moving on to another very interesting subject area, stocks. Okay. Now, at the very beginning, I'm giving you this individual person's photograph. Tell me who he is. Tell me who he is. As a person appearing, you know him. Can I know his name? Yeah. Can someone tell me the name of this individual? Very good. Thank you. That's Warren Buffett. Okay. So Warren Buffett is known as world richest man many times. Okay. And his business, what is his business? Investing in shares. That is his business. Let me show you another nice picture. When he was 15 years old, he had 6,000 US dollars. And he said, I started investing at the age of 15 and I was too late. Got it? I don't know how old you are, but he says, I started investing at the age of 15 and I was too late. Okay. Now you can see his journey. 83, 86. When he reached the age of 89, his wealth has exceeded GDP of Sri Lanka. One individual. Okay. Just look at how his wealth has grown. Now I'm asking a very simple question. There is a piece of paper. Okay. I'll take a piece of paper. Okay. You can see this. Can I fold this? Okay. One single paper. I fold it. Can I fold it again? Can I fold it again? Say yes or no. Very simple question. Yes. So I will fold it again. So this is my second folding. Can I fold it again? Say yes or no. Yeah. Third time. Can I fold it again? Yes, that's fourth time. Right? So this is the fourth time. I'm asking this. Can I fold this paper? Assuming this is a huge paper. Can I fold this paper 400 times? Can I fold this paper 400 times? Why? I can't fold this small paper 400 times. But if I have a huge paper, can I fold it 400 times? Okay. Now, what do you call this? The width of this paper, right? Say just 1 millimeter, right? So the, whatever you call this side, 1 millimeter. When I fold it 2 times, 2 millimeters. When I fold it 3 times, 3, 4. Sorry, then it doubles. Okay, when it's 3 times, right? When I fold it, the other side also has 3 millimeters. Altogether, it becomes 6 millimeters. Means what? Each folding it doubles. Each folding it doubles. Okay. When I fold it for the 400th time, I'm not going to measure it in millimeters. Here, 6 times 6 millimeters, right? Then 6 times 6 millimeters. If I fold it again on 7th time, that's 12 millimeters. Each time this width doubles, right? When I fold it for 400 times, the gap or the width is like from the surface of the earth to the moon. That distance is there when I fold this paper for the 400th time. Got it? Each and every time, if I double, when I fold it for the 400th time, the distance, now you can call it distance, not the width, is like from earth to moon. Means what? This is known as compound. Each and every time I'm doubling. Okay. So Albert Einstein has said the most powerful force in the universe is compound. So wealth compounds. That is shown by Warren Buffett here. Okay. At the age of 15 years, he had 6,000. After 4 years, it has not doubled, but compounded. Means what? You have invested a certain amount and the return plus some other you have invested. And see how it happened. When he reached 21, this 10,000 has doubled to 20. At the age of 30, 9 years, what was 20,000, he has converted into 1 million. So like in each interval, he has doubled. But how? It's happening now. Okay. So this is why he says, I started investing at the age of 15 and I was too late. Assuming he started at the age of whatever, 1 or 2. Means what? It's doubling. Okay, this 40 billion growth, he should have seen not at the age of 89, but at the age of 83 or earlier. Okay, right. So Warren Buffett is one very successful stock investor. Right. So with this understanding, we'll move into stocks. What is stocks? What is happening? How do you buy stocks? Now we are going to look into that. Okay. Shares. A very nice term. Shares. Okay. We said higher the risk, higher the reward. Okay. So that's a term we have been again and again saying. Higher the risk, higher the reward. In say 1,600, 1,700, one of the most profitable businesses was ship voyages. Okay. So you have seen a lot of nice movies on ship voyages. Okay. So when your ship goes to an unknown destination, so it starts from Spain or from those days, yeah, Portugal, later on Britain, Dutch, Netherlands, okay. So that's your starting point. And you move out to unknown destinations and you come to Sri Lanka, those days Ceylon. Suppose your ship happens to come to Sri Lanka. What do you get? Tusks, pearl, gem, spices. And when you go back to your mother country, you are a rich person, extremely rich. So you can either be a farmer and your life has no risk and no rewards. Instead, you become a sailor and your ship comes to a land like Sri Lanka. And when the ship goes back to your starting point, you are extremely rich, but the risks are very high. For the farmer, no risks at all. But here, from the very starting, you don't have proper equipments like today, hurricanes, storms, sea pirates, unknown sea monsters. Okay, then when you come to countries, there will be monsters, man-eating men, cannibals. Okay, so many things. And when you take the asset and on your way back, once again you are seeing all these perils. Sometimes the ships get capsized upside down in the sea due to storms and a lot of other perils. Amidst of that, if you become successful, you are extremely rich. Okay. Assume that you are a ship owner. So I can see about 27 members here. Let's say all of you have a ship. Okay. And you know, being a ship owner is a very profitable business, but the risk is very high. Man is a very creative animal. Okay, the dictum is higher the risk, higher the reward. But you want this reward at a lesser risk. Okay. Tell me, how do you reduce the risk and ensure high return? Tell me, how do you do that? Be creative, my dear. You have a ship, and if your ship sails, you're undertaking risk. But if the ship goes to the destination and comes back, you are rich. So risk is high, the reward is high. But you are not happy. You are very creative. Say 27 of you, all of you have one individual ship each. You want to reduce the risk and increase the reward. Tell me, how do you do that? Tell me a mechanism. Time for you to think and tell me a mechanism. Yeah, you are leasing it to someone. Remember, when you are the ship owner, you are not the captain of the ship. You are the owner. So you lease it out to the captain. But when it comes back, you are the owner, right? So that's the practice, right? So captain, really, his life is at stake. Captains, your life is not at stake because you are staying in the motherland. But ship is yours, right? If the ship capsized, it was damaged by storms, that risk is yours. That risk is not with the captain. Sometimes the ship has gone, but the captain survived. Okay, so that risk is with you. I'm asking, how do you minimize that risk, ownership risk? So the managed by captain and the crew, their life is at risk. Your ship is at risk. I'm asking you, how do you reduce your risk of ship ownership and increase the profit? Okay, insurance is the answer today. Those days you were not having insurance companies. So insurance is out. But you are very creative, my dear. Tell me, how do you do that? Yeah, think. It's not insurance. Now you have to think. Something in your hand. Selling the low risk goods. Not clear, my dear. Okay, now you go to a country and whatever you buy, you can sell it at a maximum price, premium price. So low risk goods is not the answer. There's something that will reduce the risk and enhance your profitability. What is that? Okay, there are 28 members here. All of you are individual ship owners. You are not the captain. You are not a member of the crew. You are just the owner of the ship. That's what you are worried. The problem is sometimes the ship will not come back. That is the risk you are undertaking. Ship may capsize. Very good. That's it. Sharing ownership. Thank you. Means what? One very good way of reducing risk is sharing. Okay. Now, how do you share? We have 28 members here. All of you own one ship. Now I come with a formula. Each and every one of you will own 1/28, 1 divided by 28 of a ship. Okay. And there are 28 ships. So you multiply it by 28. Mathematically, 28 cut off by 28 and you have 1. Mathematically, you own one ship. You are back to square one. Your earlier position. You own the ship. Mathematically, now you own a ship. Physically, you own only 1/28, 1 fraction out of 28 of a ship. Means what? You can't cut it and say, this is my piece. No. Out of the entire ship, You own 1/28th, and each one of you own 1/28th, right? When this entire fleet of 28 ships moves out to the sea, maybe one get damaged and it never comes back. Okay, what is your risk? Okay, one ship, 28 ships went to sea and 27 returned. One did not return, that got capsized, that's damaged. Okay, now what is your risk? Out of 28, one is your risk. Okay, who is owning that ship that got capsized? No one. All of you own just 1/28th of that ship. Rest 27 divided by 28 is your profit. Means what? You have reduced the risk. Earlier, one individual who owned this ship lost everything, 100% lost. Now your loss is 1 divided by 28. You have reduced the risk, but the reward has gone now. This is what happened in shares. I reduce the risk and I increase my rewards. Okay, right. Now you own not a ship, but a piece of paper. A certificate is given to you. Mr. Okay, XYZ, you own 1/28th of St. Mary ship. This is your certificate. Good. Now instead of having a ship, you have a piece of paper. If you owned one physical ship earlier, when you need cash in hurry, you can sell your ship and get money. Now you don't have that physical thing. What can you do? You take this piece of paper and say, here is my ownership certificate, share certificate. Take it. And I sign off. Hereafter, this 28th of the ship belongs to Mr. PQR. And my ownership is no more. I terminate that. And I get money. What is that? Share trading. Okay. So you have a share certificate, right? And now you can do share trading. Okay. So this is how we look at share market. Okay. A part or a portion of a larger amount which is divided among number of people. Okay, so we have 28 people and it's divided among 28, right? So the number of people who contribute is 28 and we have divided it to equal parts. So you own portion, one of the equal parts into which a company's capital is divided, entitle the holder to a portion of the profits. Okay, so this is how we divide it. Physically, you own nothing. I can't cut the ship into 28 pieces and give each one of you 28. Then you cannot float this. All 28 pieces will sink. Instead, physically, there is something on the paper. You have something. Now, the place where the holders of shares get together and buy and sell is becoming share market. So share market is the places where buyers and sellers meet. Today, it is called as a stock exchange, and it works like an auction. I'm the buyer, I bid, and there's a seller, they give me a price tag, and there's an argument. Okay, good. When there are more buyers than sellers, what happened? When there are more buyers than sellers, what happened to the price? It's auction. We said it acts like auction. In auction, more and more people want to own it, and very few people want to sell it. What happened to the share price? Goes up. Price goes up. Very good. There are more sellers in this auction, and very few people want to buy. What happened to the share price? Comes down. Very good. Price becomes low. Very good. That's how the market moves. Look at this picture. The bull and bear market. Okay. Okay. So this is the chart. Let me slowly expand it. Okay. So this is ASI, All Share Index, and this is timeline in Sri Lanka from January 1993 to March 2006. The bull and bear market, let me describe them later. You can see the share price index goes up, comes down, goes up, comes down. So this is how the market is behaving, going up, coming down, going up, coming down. Reach very high mountains and falls down from cliffs, going up. Okay, right. Here you can see something. Madam Chandrika Bandaranaike Kumaratunga comes to power in 1994 and she leaves government in year 2002. Just look at this time frame and tell me what happened to the market during her control. What happened to the market? Has it gone up, comes down, or remained constant? What is happening? Yeah, during this period, has it gone up, comes down? Anyway, throughout this chart, you can see it's not stable. Okay. So throughout this chart, you can see it's not stable. But I'm asking, during this specific period, was it remaining low or was it going up? Yeah, within the period, yes, it was not stable. So market is always not stable. It's fluctuating. That's where we get profit. But here, this long period of 12 odd years, more than a decade, what has happened? Was it remaining low? Yeah, it was remaining low. Now you can see pest. Somewhere you have learned political, economical, social, technical, pest involvement. That applies to us as well. Here, think about incidents. Right, President Ranasinghe Premdas was assassinated. Whatever, immediately we can see market was started to go up. Okay, then until PA was elected and until Madam Chandrika was elected as president, market continued to go up. Then there was, okay, prior to this election, there was a quick drop, then steady decline. Power outrage. Okay, so Sri Lanka experiencing power cut downs. World Trade Center bombed, that's Sri Lanka. LTT bombed that. Okay, market comes down. LTT attack Colombo airport, comes down. Okay, then PA government dissolved, market start to go up. UNP elected to office, immediately going up, then slowly coming down. Once again, LTT peace talk started. Okay, those days people thought, okay, that is the best thing. Then market immediately shot up. Peace talk commenced. Then there was MOU signed, again going up. Then Tokyo made us a donor. Okay, thanks for coming to peace talks, and Tokyo was very happy. Market immediately reacted. Okay, all of a sudden, security, unrest in Jaffna. Immediately, market reacted. Okay. Then SLFP once again was elected. Okay, our Prime Minister Ranil Wickremesinghe always had a very short duration of leadership, premiership. Immediately, market reacted, but soon it started to go up. Once again, the elected PA government went to peace talk with LTT. Once again, market shot up. Means what? Market is behaving and sensitive to all the informations, be it political, be it economical, technical, social. Market is reacting. In this market, there are two ways of investing. One is buy and sell for each of these quick reasons. The other, buy and never sell. Okay. Now, these are some other incidents. Year 2008, December, right? We were having the fourth Elam War, and the entire world was experiencing global economic recession. Market went down, extremely down. 2009 May, we ended war. What happened? Started to escalate to such an extent. In year 2011, Colombo Stock Exchange was the second best performing stock exchange in the world. And this period made many Sri Lankans rich. Okay. Everyone wanted a piece of the cake. A lot of people started trading. But 2011, latter part, market started to come down. So you can see market always goes up and comes down. Okay. When market is going up, we call it bull market. When market comes down, we call it bear market. Sometimes bull climb in steps. You can see that. Bull is climbing in steps, but the bear just jump out of the window, immediately coming down. Slowly, slowly going up, coming down all of a sudden. Okay. So we call them bull and bear market. Let me see this picture. Okay. Anyway, you can identify these two animals, I think. One is bull, the other is bear. Okay. Do you know why these two animals are often symbolized to represent stock markets? Why do you take these two animals? One is bull market, the other is bear market. Okay. Bull market is the term we give for increasing. When the market is increasing, continuously increasing, we call it bull market. Okay. So we can see in these graphs, markets were going up, and we call them bull markets. When the market is going up, it's a bull market. When the market is continuously going up, it's a bull market. When the market is falling, we call it bear market. It's a bear market. Again a bull, again a bear, again a bull. So the power changes between bull and bear. Bull represent market which is increasing. You have seen how bull attacks. How does a bull attack? Okay. When bull wants to attack, it start to push whatever from down to up with its horns. Whatever down is pushed up with the horns. That's how the bull attack. Okay, so you can easily symbolize that with its horns. Okay, so you have two horns, right? What is down, pushed up. That's how the bull attack. Okay. Bear represent continuous decline. How does the bear attack? That's in movies how the bear attack. Bear stand up with it paws, right? Whatever up is pushed down, up, pushed down. That is bear. Okay. So the same effects take place in the market. When bull is trying to increase, bear is trying to reduce. So there is a constant fight between bull and bear. So you can see that. Okay. Bear is trying to go up, bull is trying to push down. Okay. We talked about what is share market, right? So it's a place where buyers and sellers meet. We looked at ASI, all share price index of Colombo. How does it move, right? So I showed you up to 2006. Now, so this is where 2006 is. Then it was dwarfed by the sudden growth from 2009 onwards. 2015, we saw power struggle, a change in power pattern, right? So this regime, those who ended war and tried to establish very good infrastructure in Sri Lanka and taking anyway debts and doing that, they were chased out and a new regime came. But this new regime could not manage the economy well. So this is shown throughout this period, continuous decline. Then they were chased out, once again the other took power, right? So all these are sentiment of the market. So the market is not political. It's not political. It's not favoring UNP or JVP or any other political party. It is the collective mentality of the investors. Okay. So initially, the collective mentality of the investors was such: whenever PA government comes, they will damage the economy. So that was one thinking. They will damage the open economy. Okay, fine. Let's talk like that. So that is shown by this picture, continuously low. Then comes UNP, immediately market shoots up. When the same happens again, market comes down. So it's not political. It's showing collective sentiment of the investors. Whatever your political party behavior, whatever your political loyalty, the moment you end war, you believe we have come across the worst period in our lifetime. Yes. So that is the collective mentality of all the investors. Market shot up. But it creates artificial bubble. Later on, we will look into what is bubble. All bubbles burst and market came down. Then once again, okay, it will come slowly and steadily to a certain level. But it cannot go on. Political power changed. Why did political power change? Yes, there was economic reasons. But the next, those who took power could not manage it well, continuously went down. And with new hope, it started to go up. Then there was COVID effect in 2019, right? Then there was a sudden crash, unexpected incident. Now, if you can bear this, I put my money and I can see how it grows and falls. If I can stay, then I will become a long-term investor. Here I'm comparing two markets. One is Australia, the index. The other is Colombo Stock Exchange Index. Year 2000, when the first wave of COVID-19 affected, everywhere in the world, markets started to come down, whether it's Sri Lanka or Australia. Australian all low, ASPI, all share price index of Colombo. Every index in the world started to come down in the same pattern. Remember, 11th of March, schools were closed down. From that day onward in Sri Lanka, market came down. The same was happening everywhere in the world. Pandemic created panic. This kind of behavior we call panic. Everyone is selling. As I said earlier, there are more sellers and less buyers. So the market comes down. Then, for about 2 months, Colombo Stock Exchange closed down. From certain economist point of view, that's a bad thing. Maybe we were the onlyest market that was closed down continuously for 2 months, but others slowly went up. After 2 months, when the market started, it went down further, then stabilized. Now we are performing better than some other indexes. Okay, so this is how we behave. Okay, right. So we were talking about assets. Stocks are assets. Okay, so there are two types of assets. Stock is asset. So when I'm investing in stocks, I'm investing in assets. There are two types of assets: real assets and financial assets. Yeah, can you hear me? First of all, can you hear me? Yes or no? Okay, right, thank you. Right, now there are two types of assets. Real assets. These are used to produce the firm's products and services. Basically, most of them are tangible. So when I'm investing in real assets, I'm owner of a tangible thing. Machinery, factories, vehicles, properties, most of them are real assets. For the time being, we'll skip these two. After that, I'll come back to them. Sometimes there are assets that are not tangible, but they give me reliable source of income. Basically, trademarks, patents. Then comes our side. Financial assets. What are they? When I said you are the owner of a ship, is it a real asset or a financial asset? When you are the owner of a ship, is it a real asset or a financial asset? Is it tangible? So this is called, okay, now you own a piece of paper, and that is called financial assets. Financial assets. The firms finance its investment in real asset by issuing financial assets in the debt market for investors. Okay, I am issuing a piece of paper against a real asset. So that is paper asset. In other words, financial asset. A share of stock is a financial asset which has value as a claim on the firm's real asset and the income those assets will produce. A bank loan is a financial asset. A fixed deposit is a financial asset. Okay. Now you don't own anything physical. What do you own? You own a piece of paper. Paper asset. Okay. So on this piece of paper, maybe you have a nice term, fixed deposit, or promissory note, or commercial papers, or share certificate. All these are pieces. Today you don't have even papers. You call it paperless society. So you have just a number. Okay. Right. So these are financial assets, shares, FDs, deposits, savings, bonds, debentures. All of them are paper assets. Right. The currency you hold is a paper asset, a piece of paper. When I give you 5,000 rupee note, that is a piece of paper. Right. Theoretically, we believe this. If the issuer of this paper is no more, your asset becomes just a paper, piece of paper, right? If you own a ship, you have a tangible thing. But if you own a piece of paper, you just own a piece of paper, right? I'll tell you some nice examples. All of a sudden, a country called Kuwait was invaded by Iraq, and Kuwait dinar is no more in use for maybe 1 or 2 weeks. Those who came back to Sri Lanka having quit dinner found no place to exchange them. There was a country called East Germany. All of a sudden, the Berlin Wall was destroyed, collapsed, and the two countries reunited. There was a cut-off date. Within that period, you can transfer your East German currency against West German's Deutschmark. But after this cut-off date, whatever you had East German currency is just a piece of paper. Okay, so if you had 5,000 printed on it, it's no more 5,000. It's just a piece of paper, right? When a certain company collapses, maybe Touchwood. There was a company called Touchwood that was a listed company in Colombo Stock Exchange. Those who owned it could trade it. But all of a sudden, this company is no more being traded. Those who own this piece of paper just own a piece of paper called share certificate. Palwatha Sugar, that's a listed company in Colombo Stock Exchange. All of a sudden, that was acquired by government. And if you are the owner of this company and if you had share certificates, you own just a piece of paper. Earlier, maybe you owned 30 million worth shares of Palwatha Sugar. That's gone, vanished into thin air. Okay. So this is how things happen, right? So physical assets or real assets. Then you have another term, financial assets. Financial assets may one day reach to its intrinsic value. That's how they say. Okay. So that happened to Quedina, East German currency. Then companies that vanished like Touchwood, right? Palwatha Sugar, likewise. Okay. So by now you know that stock markets go up and come down, and we have seen something similar. Going up, 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 clash. Bull is climbing up in steps and bear is jumping out of the window. You don't have any time to think. Market has fallen. We call it market crash. In 1929 in USA, the stock market crashed. And it took almost 25 years to recover. Means what? When you are 20 years old, if you have deposited 1 million in stock market, you will not be able to get at least 1 million until you reach 50 years old. That is the risk you are undertaking. Okay? But that happened when stock markets were not regulated. Those days, stocks were not regulated. And by now, we have regulators, SEC. What is SEC? Stock Securities and Exchange Commission. So throughout the world, stocks and stock-related activities are regulated by SEC. So in Sri Lanka, we have our own SEC. This is another reason for the market to quickly go up. Okay, now you can see up to this level, market was slowly and steadily going up. If it continued like that, it will slowly go up like this. But instead, there was a very sudden growth. And most of the time, this sudden growth is fueled by loans, margin loans. Means what? If you have already invested in stock market, there are banks and finance company that will accept your existing share portfolio, your investment up to now, as a security and mortgage it and give you further loans only to buy shares. Okay, so that is called margin trading, margin loans. When more and more margin loans are given undetected by a regulator, this is what happens. Your affordability goes up. You want to buy more and more, and the bank and the finance companies there to support you. And what happened? There's a limit up to which you can go. After that, there are no buyers. Market crash. Okay. So that's not a healthy sign. When market crashed in US in 29, well-known writer Mark Twain came up with this suggestion. He's a very good writer who comes up with nice phrases. He said, he jumbled up all the months and said, okay, now this happened in October. So October is one of the worst month to invest. But the other months are, he jumbled all the months and said, okay, investment is always bad. That's what he indirectly said. Okay? So that's not a good sign. Now, let's look at the chat box. Yeah. How many of you have CDS accounts? How many of you have CDS accounts? Okay. How many of you have savings accounts? Say yes. Just say savings, yes. How many of you have savings accounts? Say savings, yes. Yes, yes. Okay. Right. Okay, right. Now, if I ask, how many of you have life insurance policies? How many of you say yes? Okay, right. So you are responding. If I ask the same questions from your parents when they were in your age, I will get the same set of answers. Almost everyone would say, I have a savings account, and 1 or 2 out of the sample of 27, 1 or 2 would say, I have life insurance policy. Now I'm asking, do you have CDS accounts? Here out of this 27, no one says yes, and you call yourself young. And if I go back in time tunnel and ask your parents when they were in your age, they would also say the same thing. No, we have not heard. What is that? Like you. Until you change, Sri Lanka will not change. Okay. CDS accounts means Centrally Depository System, CDS, Central Depository System accounts. So when you have that account, then only you can trade in shares. Okay. Now, financial literacy means getting to know about these things. Okay. How much do you need to open a CDS account? How much do you need to open a CDS account? No, you are not required a single cent. It's just a formality. You have to submit the documents and the CDS accounts will be created on your behalf. But you are not aware, my dear. Okay, right. How much? What is the minimum amount that you have to invest in a stock market, in Colombo Stock Exchange? If you are having a CDS account, what is the minimum amount that you have to invest? Say, for the bank to start up a fixed deposit amount, there is a minimum amount. Okay. So if you have CDS accounts, what is the minimum amount that you must invest in Colombo Stock Exchange? No, there is no such thing. Even with maybe 100 rupees, 200 rupees, you can buy shares. No such thing called minimum. Means what? You all can try it. Registration is free and the minimum amount is maybe in hundreds or maybe thousands. But you are not doing. Why? Because you lack financial literacy. In your leisure time, just think about the teledramas that you are watching. The writers of our age, imagine they are young, pace, and just write up something which has no. Yeah, okay, good question. How do you open a CDS account? Right. So you can contact any of stockbrokers. Now you cannot directly do stock trading. You have to talk to a stockbroker, right? So there are ample number of stockbrokers, right? Let's say you have Asia Securities, SoftLogic, right? There are many stockbrokers. Take a number and talk to them and say, I want to start up a CDS account. So they will send you a application form and you have to fill it. Then you have to have a billing proof, means maybe a mobile phone bill is coming to your name, to your address. Or if you have nothing, you can get even Grama Niladhari certificate and send it. Yeah. What is that? Yeah. What do you want to know? Right. Okay. Yeah. What is the benefit comes under CDS accounts? Okay. When you have CDS accounts, you can buy and sell shares. That is the benefit you have. That's all. Right. Now, there was a time you could buy shares without having a CDS accounts. Now, that is not the case because we don't deal with anything physical. Those days, you had something called share certificate. Now, physical thing is not there. It's only in digital format. Therefore, you must have a CDS account to buy and sell shares. That's all. Okay. Right. Now, when you compare with many other movies, especially in US or UK, they talk a little bit more sense. I can remember a movie, Forrest Gump. In this movie, there's a very stupid guy. He says, okay, my friend has invested money in a company called Apple, and that must be a farm, and they are sending me a check. And that's enough for me to live, something like that. Okay. So they talk about investing in Apple company. There are many movies that talk about the economic movements. I talked about a movie, let's say The Founder on McDonald's. They talk about economic sense, which I don't see in Sri Lankan movies or in Sri Lankan teledramas. Anyway, right, we were talking about. Okay, now the restrictions are not from the CDS side or any other side, but look at your own company policies. If your company has restricted to open accounts, then that's a company issue, right? But in general, no one is restricted. But maybe a company can have a policy, okay, since you may take the time and waste it on websites, there may be company policies. But in general public, no, there are no restrictions. So if check first with your own company policies. Right. So if you start up an account, you can buy and sell. I see that you have an interest. Means what? This subject may not be discussed in detail with you earlier. And you are really interested, it seems, but you don't know the path. Okay. Now, in your free time, look into stockbrokers in Sri Lanka. Talk to one of them and say you want to start up a CDS account. And you will get application, fill it, no charge, nothing. And once you are registered, it is not compulsory to do trading each and every day, no. Right? Then later on, maybe with even 100 rupees or 1000 rupees, you can simply get into market. Then study it. Okay. So next week, we'll talk about investing methods, fundamental analysis, technical analysis that will be useful to you. Yeah. So we are coming to the end of the session. Today we talked about insurance and we talked about certain principles of insurance. and we discussed with cases. Remember that Ubrema fide, causa proxima, okay, ex gratia, GWP, gross written premium, okay, bank assurance, reinsurance. Yeah, how do you get this open queue or what? Right. So with this, I'll end today's session. Thank you.